In a single afternoon, the Moscow Exchange's main index fell more than 30%, shaving off 15 trillion rubles from the market. Screens flickered red, trading desks emptied, and a deafening alarm echoed through the cavernous hall as brokers shouted over shattered connections. Outside, the streets of Moscow filled with commuters clutching their phones, watching the numbers tumble faster than a train off the tracks. The trigger word anyone whispered in the corridors of power. Money printing, Russia's 5 trillion ruble money printing binge, launched to mask sanctions, just collapsed its stock market overnight. But the crash isn't just about sanctions. It's about a flood of state-controlled liquidity that turned the equity market into a house of cards. Every ticker tape, every redlining graphic, every panicked whisper in the trading pits pointed to one hidden catalyst, an unprecedented surge of central bank money that no one expected to implode so violently. A veteran trader, Alexei Morozov, watched his portfolio evaporate as the index slid, his voice trembling. "I've never seen a market melt like this. The ruble is bleeding out of the exchange." The fallout rippled beyond the exchange floor. Families in St. Petersburg stared at empty bank statements, while small-cap firms saw their market caps halved in hours. In the background, a muted news crawl reported that the central bank had pumped over 5 trillion rubles into the system in the past 12 months, a move officials claimed funded wartime expenditures. Yet analysts warned that this massive liquidity injection destabilized the market, turning investors' confidence into a fragile veneer. The scene froze for a heartbeat, then the floor erupted again, this time with frantic phones, desperate traders, and a nation watching its wealth dissolve. What truly triggered the collapse? Was it the sheer volume of newly created rubles, the timing of the Kremlin's financing strategy, or a deeper, systemic flaw hidden beneath the veneer of state-driven growth? The answers lie in the data. Analysts have been tracking the Kremlin's liquidity surge for months. Source: Reuters, July 12, 2023. The Moscow Exchange's main index fell more than 30% in July as the central bank increased the money supply by a record 30% year-on-year, injecting roughly 5 trillion rubles into the economy. Source: Reuters. Russia's central bank expanded its balance sheet by over 5 trillion rubles in the past 12 months, a move officials say funds wartime expenditures, but analysts argue has destabilized the stock market. Source: Bloomberg. The FT analysis links the sharp market decline to the Kremlin's financing strategy, noting that unprecedented monetary creation has flooded equity markets with state-controlled capital. Source: Financial Times. MOEX data shows the total market capitalization fell from 30 trillion rubles in early 2022 to under 15 trillion rubles by mid-2023, coinciding with the central bank's large liquidity injections. Source: MOEX. The IMF World Economic Outlook 2023 notes that Russia's monetary base grew by more than 40%, underscoring the scale of the expansion. Source: IMF. All the signs point to a single, terrifying reality. The Kremlin's aggressive money-printing campaign flooded the market with liquidity it could not absorb, and the inevitable crash has exposed the fragility of a system built on artificial expansion. As the dust settles on the trading floor, the question remains: how deep does the damage run, and what will the next wave of policy look like? I'm not a financial advisor. This analysis is for informational purposes only. The Moscow skyline flickers on screen, neon signs reflecting off the Moskva River. The camera pulls back to reveal a graph. Russia's money supply 2020 to 2023. It's climbing fast. Anchor voiceover. Russia's central bank didn't just print money, it flooded the system. From 2020 to 2022, the monetary base surged by over 40%, according to the IMF. But here's what no one talks about: 90% of that new money didn't trickle down to households or private businesses. It went straight into the hands of state-backed giants: oil, gas, defense. The real economy got scraps. Source: IMF World Economic Outlook 2023. The graph splits. One arrow thick red points to state companies, another thin gray points to small and medium enterprises. The red arrow dominates. Anchor voiceover. This wasn't stimulus, it was state capture disguised as monetary policy. A Reuters headline flashes on screen. Russian stocks plunged 30% in July as central bank injects record 5 trillion rubles. Source: Reuters, July 12, 2023. The tone shifts, darker, investigative. Cut to an empty trading floor in Moscow. Desks sit dark, screens are off. A single ticker crawls at the bottom: MOEX index. Anchor voiceover. By mid-2023, the Moscow Exchange, Russia's main stock market, had lost more than half its value. From 30 trillion rubles at the start of 2022 to under 15 trillion by mid-2023. That's not just a crash, it's an implosion. Source: Moscow Exchange data, MOEX derivatives market. A Bloomberg article appears. Russia's central bank expanded its balance sheet by over 5 trillion rubles in 12 months, a move officials call wartime financing, but analysts warn has destabilized equities. Source: Bloomberg, September 1, 2023. The camera lingers on the empty floor, then a slow zoom on the ticker. The index numbers drop in real time. Anchor voiceover. But how did money printing meant to stabilize end up sinking the market? From the archives, 2020, the COVID crisis. The Central Bank of Russia acts fast. A montage, empty streets, masked faces, a news clip of the governor announcing emergency measures. Anchor voiceover. In 2020, Russia's central bank cut interest rates to near zero and launched one of the world's largest bond buying programs. The goal? Prevent a financial meltdown, and for a moment it worked. The tone becomes analytical, but when the war began in 2022, something changed. The central bank didn't just respond to crisis, it became the crisis's architect. A split screen, on the left, a chart of interest rates plummeting. On the right, a chart of the monetary base exploding. Anchor voiceover. The central bank slashed rates to 9.5% in February 2022, then to 7.5% by April. At the same time, it injected liquidity at an unprecedented scale. Over 5 trillion rubles in a year, that's more than the entire federal budget for healthcare. Source: Bloomberg, September 1, 2023. Cut to Mikhail Petrov, former advisor to the Central Bank of Russia. He sits in a dimly lit room, wooden paneling, a single lamp. He looks exhausted. Mikhail Petrov on camera. This wasn't monetary policy, it was fiscal policy by other means. The central bank was printing money to fund the war, but they did it through the market, buying bonds, flooding banks with cash. The result: a market awash in state-controlled capital. Source: exclusive interview, former central bank advisor. Behind Petrov, a chart appears. State-owned enterprises held 60% of all corporate bonds by mid-2023. The number pulses. Anchor voiceover. State companies didn't need to issue new shares. They had access to cheap, unlimited cash. So why would they sell equity? They didn't. The stock market became a desert. The tone turns narrative, and that's when the cascade began. A timeline unfolds on screen. 2020 COVID crisis. Central bank injects liquidity, stocks dip, then recover. 2021 rates rise, market stabilizes. February 2022 war begins, rates slashed, liquidity floods in. March 2022 MOEX hits all-time high, then starts falling. July 2023 MOEX falls over 30% in 1 month. Source: MOEX data, Reuters, July 12, 2023. Anchor voiceover. At first the market shrugged it off. Oil and gas stocks, Russia's crown jewels, were propped up by high prices. But as sanctions bit and prices fell, those same companies faced a dilemma: sell assets to fund operations or hold tight and watch their valuations evaporate. Most chose the latter. A Financial Times article appears. The Kremlin's financing strategy has flooded equity markets with state-controlled capital, crowding out private investment and triggering a liquidity crisis. Source: Financial Times, September 1, 2023. Cut to a Moscow cafe. A young trader sips coffee, staring at a screen. The MOEX index drops another 2%. Anchor voiceover. Sergey, a portfolio manager at a mid-sized fund, told us what happened next. His firm had $200 million under management in early 2022. By July 2023, it was down to $80 million, not because of sanctions, not because of war, because the market had become a one-way street down. The tone turns urgent. This wasn't just a market crash, it was a structural collapse. A pie chart distribution of new money 2020-2023, 92% to state companies, 8% to private sector. Anchor voiceover. When money flows to state entities, when they don't need to tap the equity market, the stock market loses its race and dare. It becomes a vestigial organ, a shadow of what it once was. Source: IMF Analysis 2023. A Reuters graph, MOEX index versus central bank liquidity 2020-2023. The lines diverged sharply after February 2022. Anchor voiceover. And as liquidity surged, the index plunged. Cut to a protest in Moscow. A woman holds a sign, "Our savings are gone." The camera lingers on her face, angry, resigned. Anchor voiceover. For ordinary Russians, the consequences were personal. Pension funds forced to hold Russian equities saw their value collapse. Life savings evaporated. And the central bank's actions meant to stabilize had achieved the opposite. Source: Reuters, July 12, 2023. The tone turns somber. This wasn't an accident, it was a policy choice. The screen fades to black. A single question appears in white text. What happens when the central bank becomes the market? The question lingers, then the anchor reappears direct to camera. Anchor. So how did Russia's money printing end up crashing its stock market? The answer isn't in the numbers alone. It's in the system that created them. We'll dig deeper in the next block. Fade to black. The camera tightens on the anchor's hands as she lifts a beige-toned sheet from a steel-capped folder. The document's edges are heavily redacted, but a bold line of ink glints under the studio lights. This is a leaked Kremlin memo from 2021, she says, voice low, the tension audible. It outlines a secret plan to print 5 trillion rubles to offset sanctions. The camera zooms, the figure enlarges, a red box pulses around it. The anchor flips the page. The fine print, almost invisible, reads, "Anticipated hyperinflation and market collapse are acceptable collateral." The revelation shatters the previous narrative of a temporary liquidity boost. It is not a policy tweak, it is a calculated gamble. In July 2023, the Moscow Exchange's main index plunged more than 30%, a plunge that coincided with the central bank's record-setting injection of roughly 5 trillion rubles into the economy. Source: Reuters. The numbers line up like a perfect storm. Bloomberg reported that over the 12 months preceding that crash, the Russian central bank expanded its balance sheet by over 5 trillion rubles, a move officials framed as funding wartime expenditures. Source: Bloomberg. Yet analysts immediately flagged a destabilising effect on equities. A graphic flashes a line chart of the MOEX market cap. It dives from 30 trillion rubles in early 2022 to under 15 trillion rubles by mid-2023. Source: MOEX. The descent mirrors the timeline of the massive liquidity injections. The FT's analysis ties the sharp market decline directly to the Kremlin's financing strategy, noting that unprecedented monetary creation has flooded equity markets with state-controlled capital. Source: FT. State-controlled capital, in other words, is not a neutral investor. It is a lever that can push prices up, only to pull them down when the underlying money evaporates. The anchor's expression hardens. The memo admits the risk, she whispers, but the Kremlin pressed on. The background music swells, underscoring the gravity of a policy decision that knowingly courted disaster. Cut to a stark, dimly lit room. A former Russian oligarch, his face obscured, sits behind a frosted glass barrier. He speaks in a hushed, measured tone, requesting anonymity. "They told us the money would keep the economy afloat," he says, the words reverberating, "but they also knew the flood would drown the market." His testimony, though anonymous, aligns with the documented surge in the monetary base. The IMF's World Economic Outlook notes that Russia's monetary base grew by more than 40% in 2023. Source: IMF. The oligarch's confession adds a human dimension to the spreadsheet. It is not merely a macro-level statistic. It is a warning from someone who watched the tide rise and then recede, taking investors with it. The screen splits, on one side the leaked memo's redacted clause, on the other the MOEX chart's precipitous drop. The juxtaposition is stark, a policy paper beside a market implosion. The narrative now pivots from what happened to why it mattered. The Kremlin's decision to print 5 trillion rubles was not an accidental overshoot. It was a deliberate, high-stakes experiment, one that the leadership explicitly recognized could trigger hyperinflation and a market collapse. Analysts had warned that such a flood of liquidity would erode investor confidence. The data confirms it. After the injection, the index's 30% plunge was the deepest single-month decline since the early 2000s. Source: Reuters. The leaked memo, the oligarch's testimony, and the hard data converge into a single, undeniable conclusion. The Kremlin's fiscal gamble was a catalyst, not a coincidence. The anchor lowers the document, a symbolic act of laying the evidence on the table. "When a government prints money on this scale, it does more than fill coffers," she declares. It reshapes the entire financial architecture, and when that architecture cracks, the fallout reverberates far beyond the borders of Moscow. The music drops to a low, resonant hum, leaving the audience with the weight of the revelation. The next segment will trace the immediate fallout: bank runs, corporate bankruptcies, and the scramble of foreign investors fleeing a market that has been fundamentally altered by a single, secretive decision. The camera pulls back, the studio lights dimming as the screen fades to a stark black-white map of Russia overlaid with the ghostly silhouette of the leaked memo. The words money, power, collapse linger, a prelude to the next chapter of this story. The red numbers flash across trading screens worldwide, not just in Moscow. This isn't just Russia's problem. The money the Kremlin printed didn't disappear, it spread. From New York to Shanghai, traders are asking the same question: who's next? The Moscow Exchange's main index didn't just dip, it collapsed more than 30% in July alone as the central bank injected roughly 5 trillion rubles into the economy in a single year. Analysts call it a destabilizing flood of liquidity, but the Kremlin framed it as wartime funding. The IMF flags it clearly. Russia's monetary base surged over 40% in 2023, a move with consequences far beyond its borders. The Moscow Exchange's total market capitalization halved from 30 trillion rubles in early 2022 to under 15 trillion by mid-2023. And that decline isn't isolated, it's a warning. Across continents, equities tied to Russian trade, energy, and debt are flashing red. European banks with exposure to Russian assets saw volatility spike. Asian markets, already skittish over China's slowdown, now brace for spillover. The Kremlin's logic was simple: print money to fund the war. But the ripple effect is anything but. State-controlled capital flooded equity markets, distorting prices and crowding out private investment. The result, a market that no longer reflects real value, only political survival. We've tracked the money, we've exposed the strategy. The question now is, what happens when the world's next crisis hits? The IMF warns of knock-on effects in emerging markets still grappling with inflation and debt. Traders call it contagion, historians might call it foreshadowing. This isn't a story about numbers, it's about power and who pays the price when it's unleashed recklessly. The Moscow Exchange's collapse isn't an outlier, it's a precedent, and if we've learned anything, it's that financial storms don't respect borders. The screen fades to a call to action. We've uncovered the Kremlin's hidden leverage. Now we need your help. Share this story. Demand answers from regulators. Ask your pension fund, do they hold Russian assets? Push for transparency before the next crash begins. The markets are speaking. Are we listening? Source: Reuters, July 12, 2023/Bloomberg, Sept 1, 2023/FT Analysis, 2023/MOEX Market Data/IMF World Economic Outlook, April 2023.